All right. Good afternoon, everyone, and thanks so much for joining us here today. Our session today is titled "The Coronavirus Emergency Funding for Advisors." We're really excited to bring you this, real-time information, just because it honestly it's so important. It is so topical that we really want to try to make this something that we can shine a spotlight on for the next 30 minutes and talk a little bit about what's out there in terms of the financing, the resources. We've got some interesting updates that seem to be daily at this point, from the SBA. Live Oak's been great about keeping you and I think, appraised of all of that activity. And again, it does seem to be needed to be updated in real time. But you've also got, there's still deals happening right now. There are practices being purchased and sold. We shared on a webinar late last week on Friday, just some of the deal activity that we had been seeing and what was going on. And, we want to try to bring some of that additional real-time information because it's changing like everything else in this world right now, day by day, week by week. So we're going to kick things off here. I've got a few slides prepared, and then we've got a really good group of panelists joining us today. For those of you that don't know Succession Resource Group, I'll throw this up on the screen ever so briefly. Again, I'm David Grau Jr., the president and CEO of Succession Resource Group. We're a group that is dedicated to one thing really well. We help people buy and sell these businesses, do succession planning. Related to that is financing and helping you, run and build a valuable business that can outlast you. So we cover a variety of topics, but it is all focused around what we're talking about, today, the value of your business, the financing, the needs to continue to build and grow this enterprise. Yeah, short term, but keeping an eye on the long term. So when you're ready, whether it's buying, selling, valuing the business, or just focusing on improving it, setting up entities, getting employment agreements in place with your key staff. God forbid, you don't take advantage of the payroll protection program or things stay bad long enough. You have to lay people off. You want to make sure your business is protected, that you're not going to have staff that you had to lay off, leave out the back door and take client lists, things like that. So we can help you with all of those topics when the time's right. But for today, I want to dive into the content because we've got so much good stuff here in such a short amount of time. We're going to kick things off real quick with just a market status, what's happening here and now. We'll get to our panel discussion. I put up, some of the general topics we plan to talk about that you saw in the introduction there. We're going to interlace that with, Q&A that you all have. You've taken time out of your day. We know you have questions. You may have more questions as we get into the content. So we're going to weave those in, and what we don't get to organically during the presentation from our panelists, we'll make sure we get to towards the end. So let's dive into where are we at now and who are our panelists that are going to be providing content. You probably saw it on the email invite that we sent you, but we've got myself there on the left. You got John Turner from Live Oak Bank, great long-term partner of ours, both John personally, but also Live Oak as an organization. They've done a lot for the industry. Dustin, who we've worked with, I think I worked with Dustin probably the longest, back to mid-2000s. And so again, another great example of a lending partner that's got some staying power. They got a lot of experience, and with that experience, I think we can learn a little bit today on what's happening because they're still doing deals as well. And then Jeff from Pinnacle, another great partner, really good newer partner of ours over the last couple of years. I call that newer, but all three of these panelists have been and are actively doing deals. John, given Live Oak is one of the SBA preferred lenders, has a lot of great experience. And again, as John will share, I'm sure, Live Oak isn't just an SBA lender. They are the largest, SBA lender on those 7-8 programs and probably others, but the ones that we care about specifically, best in class. So they've got a seat at the right tables. He's got more real-time information than frankly most folks would have. So we're excited to hear from him. We'll kick it off probably with some of those SBA programs, and then we'll get into some of the other stuff. Market status, ever so quickly here, then and now, up until the end of 2019, frankly, until March, it was very much a strong seller's market. Multiples for practices were going up. I don't care, whether you talk to one of the investment bankers out there for the sort of mega RIA deals and you're talking about earnings multiples. or you're talking to a firm like ours that works in sort of that $1 billion RIA space and below, the multiples, top line or bottom line multiples, they had been going up every single year. Deal volume has been going up every single year. Practices were undervalued, especially that $1 billion space and below, where you can leverage the financing from one of our 3 great partners on the call today, for example. Down payments were going up. So it was a great market, great time to be buying and selling, really good time to be selling, but not a bad time to be buying either. Where are we now? Well, honestly, it is still actually a seller's market, and I'll give you a short explanation as to why, but it's not 54-1. That was our previous buyer to seller ratio as we closed out 2019, and we had expected it to only continue to increase. Well, not right now. Deal volume has slowed a little bit. I mean, you have the field sort of split. You have those that are just staying in the game, staying the course, and restructuring. The deal, the value, sometimes both, sometimes neither. And then you have those that are just stepping to the side. They're waiting on the sidelines. We had a couple of our deals in March, where we're down 22% on deals closing, that have just decided to wait until midsummer for most of them. No one's postponed indefinitely. They just kicked it out a few months. Still working on the deal, but not trying to get anything closed in March or April, that's for sure. Good news is if you are an advisor who was contemplating, selling or retiring, this year, next year, it may still actually be the best time for you to do that, at least in the next couple of years, because active sellers right now, big or small, are very much a commodity. We're just not seeing the high volume of those sellers. And I can assure you, once you see a steady rebound, whether it's more U-shaped or sort of that V-shape everyone's hoping for, whether it happens in Q2, Q3, Q4 of this year or next, either way, when we have the rebound happen, it'll be the same as coming out of the Great Recession, where you're going to have a whole bunch of advisors coming to market who are ready to retire now. And that's not the best time necessarily to be coming to market when you've got everyone else looking to list. So now could actually still be the right time for a lot of you listening. Cash deals, less common. I'm going to skip over that one in any real depth just because we've got a panel of banks here that will give us some real insights into the financing and how it's changed as of late. The last one is RIA values are steady, and we've got video here so you can see my air quotes. The value of RIAs are steady. A short-term hit, which is where we're at now, Q1 billings will probably be down for most of you. Not all. We have had a couple clients that are steady or up slightly. But for most of you, they'll be down 10, 15%. And if we annualize that, sure, it doesn't look as good. But the long term, when you're valuing an RIA, you're really looking at this asset's ability to produce revenue into the future. And that future isn't 20 years out, but it's also not 1 month, 2 months, 1 quarter out. We're generally looking at the next 5 to 10 years, and the long-term outlook for an RIA over the next 5 to 10 years is the same now as it was 2 months ago. But at the same time, as the lenders will articulate, and we know it too, working with all of you, listening today, and when the time comes, and even current clients closing deals now, yeah, the long-term outlook is important, but the deal has to cash flow in April and May and June. So we have to have that balance of short-term and long-term. So the deal terms have changed. They will continue to change for now. Something we'll spend some time focusing on. But when you compare 2 RIAs side by side, one with $1 million in fees wrapping up last year, one annualized for Q1 that's down 10%. If the overhead stays the same, the value for now is the same, or maybe down slightly. But in general, most buyers are still, in my example here, paying the $3 million. But the terms you'll see is where I wanted to put our focus. Terms have changed a lot. Where you used to be able to get 70% cash up front, 30% held back for 12 months, and sometimes they were just all cash deals. Now most of the deals you're looking at are more 50-50, and pushing the envelope, you might get a 70-30 deal for a really sweet practice with a really big buyer. So that's my point on values. We get this question a lot and a lot lately. Right now, I'd say they're relatively steady, but we'll continue to monitor the situation. So let's get to what we actually came here for, and that is our expert panel. John, Dustin, Jeff, you guys are best in class. We have appreciated the partnership and the resources you've been able to bring us and our clients over the years. So we're going to dive in, and since our marketing team put the pictures here in order from John, Dustin to Jeff, I'm just going to go through and ask the questions and ask each of you just to respond in order, and that should help us move us along quickly. I do encourage you again, for those of you listening in here today, I know we got a lot of participants, which we're really excited about having you here. Ask the questions. I will be keeping an eye on them, and like I said, asking them along with some of my prepared questions. To the extent that we have enough audience questions, then we'll certainly skip over some of mine, and then we'll close things out here today, hopefully on time. So to open things up, my first question is just kind of a broader one, and that is, for the three of you, starting with John, are you all still actively lending? I mean, are deals getting done, whether they're through us or anybody else? John, what are you seeing?
Yeah, absolutely. We are definitely seeing deals done. In fact, when we had one close, I looked at it come across the line, I think it was last night. So definitely still closing deals. As you said, there's a few adjustments to kind of the terms of those deals. And I think we're going to be getting into that detail a little bit later. But yeah, it's still a great time. And again, perhaps a little bit later in the presentation, it might be even a better time right now to start really looking at deal making. And so hopefully we'll get into that a little bit later.
Yeah, okay, perfect. Dustin, your perspective?
Yes, we are still lending. Deals are getting done. We are seeing the deals that were, close to the finish line get done. Not a lot of changes to terms, but we're also seeing a lot of transactions be put on hold. As people want to wait and see how this plays out. And, I think time is the big uncertainty here. So seeing what the ultimate impact is to the business and profitability has resulted in some of the delays we're seeing.
Yeah, okay. Jeff, same question to you. Where are you guys at on deals? I know you've done a few recently for us, but hopefully more of the same?
Yes, absolutely. We're still lending. As everyone has mentioned, things are getting tighter, and we are doing a little more stressing on deals that we would have in the past, but we're still lending, we're still closing deals, we're still moving forward with new credits.
Okay. Well, it's good to hear that, hopefully, for those of you that are midstream with the deal or plan to continue to focus on growth through acquisition, because, honestly, now is still a good time while you've got a lot of your peers sitting on the sidelines, are focused on battening down the hatches with their clients. Clients just, aren't as well trained. Could be your moment to shine and get in there and start rolling up some practices. But let's get to, I've got a bunch of questions already that have come in from some of you listening, and they are mostly so far about the next question, which is a wonderful segue for you, Mr. Turner. And that is, can you share any details in a relatively succinct form? I know there's a lot to peel the onion back on this, but about the stimulus package, the SBA programs, all the free money that's out there, as we've heard about.
Yeah, absolutely. And like I said, I'll try to be as succinct as I possibly can, but I think there's probably 4 elements potentially we should talk about, maybe 3, but for depending on how you slice it, but let's kind of talk about those very briefly. The first one is the economic injury disaster loan, sometimes called EIDL. It's available. It's an existing loan, been around forever. It is a loan. It's at 3.75% is the rate on it. The term is up to 30 years. The small business will tell you what the term is going to be. And, so you don't really get a chance to kind of dictate that. It's going to be whatever it is. It's a loan. You apply for it. You qualify for it. It can be a bit challenging to get. So, for example, your governor does have to declare your county as a disaster area. And if it's not declared as a disaster area, you're not going to get the loan. The other thing is you do have to prove that there's harm. So you have to do that. Another piece of it is that there is, that's attractive, is there is a $10,000 grant that's in the front end of that also can be available to the Paycheck Protection Program. That's the program that $349 million was authorized for allocated for. It's being distributed the U.S. Administration and the Treasury Department. It is really designed, the spirit behind it was to really put money into the pockets of the employees. And the assumption is that they have pent-up demand. You know, they're going to want to go out to eat. They're going to want to go shopping. And so if they have money in their pocket, they'll spend, and this economy will become roaring back. So that's really kind of the philosophy here. It starts off as a loan. It has a 2-year term on it. The first 6 months is deferred principal and interest. And if the spending is correct, then it can be forgiven. Very quickly, the way it's calculated is you basically you look at your average monthly payroll, you multiply that by 2.5 times, and that's what you would get for the amount. There are some notable reductions in that. One is for federal taxes, one is for income over $100,000. You're limited to $100,000, a couple of things like that. The way then that you recapture that, or the way it's forgiven, is once you receive the money, so when the loan closes and you receive the money, the clock starts ticking and you have 8 weeks to spend the money, and you must spend at least 75% of it on payroll. It can be payroll, that kind of a thing. You could spend up to 25% on things like lease or mortgage if you own your building, or on utilities, that sort of thing. But if you spend it all, then at this point it would be considered you would get forgiveness, and that forgiveness at this point would be considered not taxable. And they've kind of gone back and forth on it, but that's kind of where it's at right now. So it's not taxable. There's a whole bunch of swirl going on right now. I'm just going to say that. It's partly because I think that the Treasury Department jumped in late in the game, and so some of the rules are still being clarified even just last evening. So there have been some loans processed. They mainly have been pilot loans, testing, and making sure the system works, that kind of a thing. We're definitely kind of starting with our existing customers, getting those folks through, and after they're through, and we get really kind of, I think, good at the process. We'll be doing this electronically for new customers, new folks. And I know, David, you'll be passing out or sending out at the end a link for how they could get into a queue for that, and also a link for some Q&As. Just quickly moving to the other two pieces. If you have a Small Business Administration 7A loan, $19 billion is allocated to this part of the program. The Small Business Administration is coming in on your behalf now and making payments for you for the next 6 months. So it's not a deferral, they're actually paying. So your Uncle Sam became your real uncle for a moment, and they're now making payments on your behalf for you. We at Live Oak Bank have already shut off all the ACHs for our customers, and we'll start those up again in about 7 months. In addition to that, if you need additional help, we will defer. We can defer for another 3 months, principal and interest. And if you need even further help, we can defer, or we can, go interest only on another 3 months. So you get up to 12 months worth of relief on these notes. Also, any new loans that are closed prior to September 26th, I believe, those loans also are going to enjoy the SBA making payments for you on your behalf for the next 6 months, principal and interest. So it kind of gets back to, if you, if you're in that situation where you have a deal in process, you might, and you thought about pausing it, you might really consider, taking that forward so that you could recapture that benefit. And I think I'll pause there, David, and if there are questions, we'll let them drive any details that they want.
Yeah, no, that's perfect. And before I get to the questions, I know you mentioned some of what the SBA and Live Oak is doing for current customers, for example, that have loans. Dustin, Jeff, I'll start with you, Dustin, but I know we've texted back and forth on some of this stuff. Anything that PPCLOAN and your partner banks are doing on this front in terms of like deferments or forgiveness on anything?
Yeah, we unfortunately haven't received the same level of support from the SBA or Uncle Sam in terms of the government coming in and guaranteeing payments on any existing loans. But we are working with any of our existing customers, who may have a need for, whether it's deferment, interest only, combination of the two. So we're really evaluating everything on a case-by-case basis, for those clients who are experiencing, a hardship or potential problems in cash flow with the market decline.
Yeah, okay. And Jeff, same question to you. You guys doing anything there at Pinnacle and your banks?
Yes, definitely. We were notified yesterday that we will be doing some relief. It will be a 90-day program, all deferred to the end of the loan. It is by request, so we're going to wait and support those that need it first, and any that request, we can put that deferral in place. But that is for existing customers right now.
Perfect. Good. Okay. Thank you. So yeah, a few of the questions. So the first one, as you'll hear from Bonnie, is geared towards you, John, what you had shared on some of the PPP program. It says Live Oak is not accepting PPP apps from those not currently as a client. If that's the situation with them, what's their expectation of our clients being able to get them from other lenders?
David, can you actually hear me right now? It shows that my.
I could, and then you muted yourself.
Oh, how about now?
Yeah, there you go. There you're good.
Okay. Repeat the question. I was fiddling with my mic a little bit.
Yeah, no, you're fine. So it just said that Live Oak's not accepting the payroll protection program apps from those that are not currently a client. So if that's the situation with them, what is their expectation of our clients being able to get them from other lenders?
Excellent. Right now, there's very few lenders that are actually ready to go. In fact, there was a Forbes article that came out at about 1:40 p.m. Eastern time that was stating the same thing. What's happening is because things were put together so late in the game by the Treasury Department and by the Small Business Administration, it's just tough for it to get going. As I said, we will work with our existing customers first. And we also think that's helpful because, for the benefit for newer customers is that hopefully the bugs are worked out by the time we get to those. We do have a queue that we're putting everybody into. And, really once we feel like the application's in good order, the process is in good order, we've tested that with our existing clients and others. Then for us, it really is a keystroke. It goes live. We push out an electronic application to everybody. They fill it out online. They would upload their documents online. We would process it automatically. There's a need for at least some human intervention. We have to review the document, but we think it'll go fairly easily once it's available. But it is kind of how do you eat an elephant? It will be one bite at a time. And so, right now we're kind of in that process of testing it with some of our current folks.
Yeah, okay. And this one I think is probably, they've addressed it to Jeff, but Jeff, can I refinance my mortgage on my office building? Can I roll existing loans from other sources? But I imagine some of you others might have comments here as well, but I'll start with you, Jeff.
Yeah, we're really business as usual, Dave. We're doing the refinance piece the same as we always have. The only difference is, obviously we have reductions in revenue. So we're going to look at those reductions and the potential reductions that could still happen over the next quarter. And, we'll stress the deals and make sure they're still going to perform. And then we're going to close and work and be on the same time service that we always have.
Okay. And what is turnaround time on something like that at this point for you guys, Jeff?
For us, it's about 5 weeks from the point that we get a completed loan file and an executed term sheet.
Okay. Got it. Dustin, same question to you. You guys do real estate stuff as well, I think?
Actually, not that often. Our focus is on the needs of the business itself in terms of mergers, acquisitions, amongst other things. So, from a refinance standpoint, there, yes, we are still business as usual.
Yeah, got it. And time frame for you guys?
We're usually 45 to 60 days, probably from start application to closing. I mean, we've done stuff in a quicker amount of time. Sometimes things take longer. We always tell people, the process is dependent on how fast we can get information from the client.
Okay. And John, you guys, I know you finance real estate because you've done it for a few clients recently, but advise?
Yep, yeah, definitely. Yeah, we definitely will refinance if it doesn't trip the predatory lending rules, and we'll finance real estate. And again, actually, if it closes in that 6-month window, we get 6 months of principal and interest pay.
Yeah. Okay. Got it. And what was the deadline for that to take advantage of it? 6 months?
It's September.
Okay.
It's 6 months from the date that the legislation was signed into law.
Got it. Okay. And this is kind of a related question, but a little bit more specific, and that is now a good time to refinance a loan from a previous deal? You know, are rates coming down at this point? I mean, we've all seen what's happened with mortgage rates relative to, you know, the Fed rates and the Treasury rates. But start with you, John, since you just finished up. Now a good time in your mind?
Yeah, I mean, absolutely. You know, rates have come down, and you know, it looks like they might stay down for the foreseeable future. So yeah, everything's is quite competitive at this point in time. And like I said, not to beat a dead horse, but again, if you get Uncle Sam to pay 6 months worth for you, it makes it even more competitive at this point.
Yeah. Okay. Dustin, your thoughts? Good time to refi?
It can be. I mean, especially considering people are looking at declining revenue streams. As we know in this industry, declining revenues typically fall straight to the bottom line. So if you did just get in the loan in the last few years, depending on the rate, the terms, there may be some value in refinancing over 10 years to lower the payment and free up some cash flow to weather the storm.
Yeah. Okay. We've gotten that one taken care of. The next question, this is for you, Dustin. They said, Dustin, this is from Michael. To your comment about deals being put on hold, which parties are most responsible for putting on the brakes? Buyers, sellers?
It seems to be kind of a mutually agreeable situation between the two of them, because that, especially when you're just opening up conversations with the seller, you're in the early stages of discussing all aspects of the deal, and you haven't necessarily agreed on price and have a signed letter of intent in place. I think everyone understands that, both buyers and sellers are spending probably 99% of their time dealing with the clients. So I think both parties are seeing this as an opportunity just to kind of slow down for a bit and let the dust settle.
Yeah. Okay. This one's for you, John, and that is, can a solo practice get the paycheck protection program?
Yeah, there's actually kind of a couple different ways that it works. So if you're a solo practitioner, and let's say you have staff, you would have a form 941 that you'll use to document the payroll on the staff. For you'll use your 2019 Schedule C net profit. Obviously, if you don't have any staff, you'd still use just for yourself then your 2019 Schedule C net profit. So yes, for if you're just a sole prop, you still get to qualify. You still can calculate an amount. Again, though, remember the maximum is $100,000. So I mean, if your 1099 is 180,000 or higher, it'll be $100,000. And I know the quick math on that, basically it works out to be about $20,000 note that potentially could be forgivable if you meet the criteria, if you spend the money within 8 weeks, 75% at least for payroll.
Yeah, okay. The next question comes from Bill, and I think I know the answer just having had this one before, but John, I'll let you chime in as well because I'm going to assume it ties back into that PPP program. Mm-hmm. And that is from Bill, do distributions in an S Corp count as dividends? And I mean, the short answer is yes, distributions, dividends, guaranteed payments if you're more of an LLC structure. All of those fall into that same category as money that's distributed to the owners. And I don't believe that's counted in the calculations for that PPP program. Is it, John? Correct.
I mean, it is a paycheck protection program, not a profit protection program. So if you have K-1 distributions, an example, that's excluded from the calculation.
Yeah, okay. Yeah. I want to get to one of the other questions that I had prepared, and that is, for the deals that you're getting done, the payroll protection program and some of the other programs, aside for a second, has your guys' underwriting changed or criteria for, approving or not approving a deal changed a lot? And I'll start with you, Jeff. Where are you at on this?
Well, I guess the one thing to keep in mind is that everyone is remote now as we're going through this crisis. And that does create a little bit of time in order to get credit committees on some of the larger deals and just simple process time. So it can add days. It doesn't add weeks, but it can add days.
Okay.
And outside of that, I mean, we are able to conduct business like we normally have. We've been efficient at it so far.
Yeah. Okay. Got it. Dustin, same question to you.
Yep. So the program, its parameters, the guidelines in which we lend have not changed. We don't expect them to change. The one thing I've told people is, the higher risk transactions that may have been we may be on the fence somewhat pre-COVID.
Sure.
Probably easy knows after. What specifically does that look like? If a deal is at debt service coverage minimums at 19 and we're looking at projections and stress tests, we know for a fact that it's going to drop below that and could be problematic. So those become challenging, but overall it's business as usual.
Yeah. John, same question to you. Where are you guys at on your underwriting criteria and loans?
Yeah, I would say that there've been a few adjustments. We're still doing 10-year term with no prepayment penalty. I would say we're not doing really 100% financing anymore. I would say we're looking for 20, 30%. Brought in either seller note or cash by the buyer, something along that lines. But everything else is pretty much the same in terms of the credit box, same debt service coverage ratio, same strong balance sheet, all those kind of things. Still need a third-party certified valuation to be part of the deal.
Okay. And I know you mentioned the 100% financing, those all cash deals, and that's actually kind of my follow-up question. So I'll start with you, John. I mean, are there instances, now where you guys could still do a 100% finance deal? And if the answer is no, which I think it probably is, what would the other 20 or 30% that is seller carried or brought to the table by the buyer need to look like? Are there any requirements you can share?
Again, yeah, I would say at this point, we're not seeing any 100% finance deals. If it's a seller note, a lot of times that's where we see the clawback placed in, clawback language. If it ends up being cash brought by the buyer, then they might still use an escrow account, to be able to establish, some of those clawback provisions and be able to hold back. And again, just looking for a good, strong language on that.
Okay. Dustin, same question to you. Instances where you guys could do 100%, and if not, what's the balance need to look like?
Yeah, we still will offer it. Again, it wouldn't be a scenario where you're likely to do 100% financing with all cash paid at closing. We'll still accommodate, the look back provisions in the form of a holdback or an escrow account. But, I think the big difference on that will be too is, what are the provisions of those future funds to be dispersed? Are they simply tied to a clawback? And I think that's where people can get creative. And it still makes sense from a 100% financing standpoint, because looking at cash flow and looking at the example you laid out early on in the webinar, 50% of a purchase price compressed over 5 to 6 years is a pretty large increase in your monthly outflows. So again, there's a lot of value in that option because you're financing the transaction, all of it over 10 years, but we are going to be leaning. I mean, it'll come down to who the buyer is and making sure that they're qualified for that type of financing.
Yeah. Okay. And Jeff, last but not least, your perspective?
Yeah, we're doing 100% financing still. We're really looking at them the same way we always have. We do obviously have deals with the sellers carrying back some of that financing, but in typical scenarios, that's a negotiation between the buy-sell. It's not necessarily something we're requiring to make the deal work. We obviously lean heavily on the embedded cash flow of the existing firm and making sure that is consistent and we feel like going to be ongoing. And then we're going to stress both sides of that, as I mentioned earlier, and make sure that we can still carry that as the market transitions throughout time.
Okay. Yeah, perfect. Broader question, and I know each of you have an opinion on this, and that is, what's your outlook? I mean, we know how March was, now that we can close the book on that. What's your outlook for mergers and acquisitions as we look into Q2? Just thinking about, the financing ties into the underwriting criteria we just covered. Again, I know the markets none of us have any control over, but we're already seeing where everyone sort of immediately paused and took a breath mid-March on deals. We're already seeing some of those deals start to pick those conversations back up. So we're optimistic for April that we expect deal volume and therefore maybe loan volume probably down a little bit, but to see a steady increase over where we ended up in March. But John, what are your thoughts on Q2 and even out into the rest of 2020?
Yeah, it's a good question. I think there will be a very short-term distraction. Advisors apply for the PPP, the Paycheck Protection Program. But I think if you get past that, I think there's strong incentive on buyers' parts to look at closing deals if they could by September, so they could get part of their loan paid for by the SBA. I also think some sellers are probably starting to think about putting two and two together and wondering if taxes might not be quite significantly higher next year as we try to pay for the 2.3 trillion that just went out the door, and are maybe considering it similar to the old Roth IRA conversion days. Maybe now's the time, to go ahead and sell and get the proceeds through the tax sale, before taxes go through the roof. And again, no guarantees, but somehow they're going to have to pay for that 2.3 trillion.
Okay. Yes, for sure. Dustin, over to you.
I do think we're going to see a little bit of a slowdown in quarter two. I think John used a good word there, distraction. We know how everybody's committed to clients at this point in time. I think it'll slow down there. But again, I think moving forward, I think the big word is going to be opportunity. So a lot of well-positioned buyers, going to have an opportunity with an aging advisor force that was aging all the way back to 2008 and 9 when we had a problem, and they're 10 years older now. So, I think there'll be a lot of opportunity. I think it'll pick back up quickly. We just have to get through this time period of uncertainty.
Yeah. Okay. Jeff, any closing comments on this question? Your thoughts?
Yeah, I agree with both of the panelists. I think that it will be a little bit slower on the acquisition side, although we are seeing an uptick on the refinanced volume. I think people are finding an opportunity to structure their loan as it was mentioned earlier, bring the term back out, and obviously rates are in the low fives right now, so it's a wonderful time to refinance your deal.
Okay, and I was going to ask you, Jeff, because I know you did refi for one of our clients here recently. Typical interest rates? I mean, I know I'm not going to hold any of you to anything, but just put people in the ballpark.
Yeah, 5.35 to 5.5 right now fixed would be a ballpark.
Is that a 2-year payback?
Yes, 2-year payback. No, that'd be a 10-year AM, 7-year term.
All right, got it. Perfect. So to wrap things up, I want to ask one last one of each of you, because again, it's one that I know you'll have interesting insights, perspectives for everybody. And we've got literally still, 18 more questions that have been asked. And for those ones that we weren't able to get to, because they are, very technical questions, we'll make sure to respond to you just via email, but you will get a response. So the last question I want to chime in here on is for deals that are already in progress. And you know how long these deals can take. Some of them get done in 30 days, but most are 3 to 6 months on the short end. So for deals already in progress, what's your advice? What advice would you give to buyers to help keep that deal together, just given how much has changed, financing, cash flow, working from home? I mean, there's just a lot that's changed. Jeff, your thoughts, what advice would you give?
To keep the deal together, I think the biggest thing you can do is stay in communication with one another, and have that good line of communication that, everyone's going to get concerned about a drop in the equities market, and everyone wants to know that they're making a good investment and that the investment is going to pay off. So I think the communication is there. Lean on your specialist, your financial specialist, to help you and guide you through some of these concerns and questions on both sides. Make sure you're keeping that line of communication open as well. And I just really feel like this is going to be a little bit of a bump in the market, and we're going to come out of this stronger as we continue to pump capital into the market and continue to support these customers.
I appreciate the optimism.
Yes,
Dustin,
thank you.
your thoughts?
My recommendation, and I think one of the hot topics moving forward will be deal structure. Buyers and sellers need to be willing to work, and I think you can get creative around using seller financing and holdbacks. I've always looked at, I think you'll have a group of sellers probably that says, well, let's wait another year, 2, 3, and see where the market goes. But that doesn't mean deals can't be done now to a point where historically, buyers absorbed all the market risk to the downside, but got all the benefit to the upside. Maybe there's a way to work in earnouts and things where, it's not just specific to look backs and things, client retention, but talk about where you're headed. If you've got a seller who wants to sell now and stick around for 2 to 3 years, that's a great opportunity to get creative and put a structure in place that's going to really benefit you both long term.
Yeah. Okay. Yeah, I couldn't agree more. And John, closing it out, your thoughts on keeping these deals together and in play while everything changes around them?
Well, you know what? I think there are some things that are transcendent, that transcend even the current situation that's going on with this horrible pandemic and the economic impact of that. And I think, I just harken back to the 5 C's, that those still are there. That cultural fit, if you're a buyer and a seller, it's still there. The character we talk about, it's still there. Your capability to deal with the most difficult case in that book, it's still there. Your capacity, still there. Capital, believe it or not, still there. Those things are still there. And so those deals that are in process, I think I agree with Dustin, those are still all great matches. And sometimes it's hard to find that great match. And when you find them, you don't want to walk away from that. You just both have to be a little more flexible on how to get the deal done. And even so, even right now, most advisors are still up like 15% over where they were last year. I mean, if you're a seller, not saying you have to take a reduced amount, but even if you did, last year was a pretty good year too. So, I think the amounts can be fair, and I think the deals could be fair, and I think those principles are solid and are still there. Just hang your hat on those principles. Go back and revisit the 5 C's and begin the conversation again if you need to.
Yeah, great closing comments. And I'll wrap it up with my answer to the question, because I've heard all of you mention the F word, and that is flexible. Just given all the stuff that's changed, people having to work remotely, manage their staff remotely, the markets, I generally say moving up and down, but right now it just seems like down. But who knows, over the next couple of months, quarters, certainly the next year. So be flexible. You can get these deals done. To John's point, you had a good fit, you had a good match. The person that you picked to take over your business is a great fit for your clients, and you want to slow down. Don't let these short-term distractions, as we've all highlighted, delay a deal or blow a deal up. Be flexible, but at the same time as the buyer, don't overreact. We've had a couple of these situations in the last, week or two where it is a lot of doom and gloom out there. The SBA has given us, some relief as small business owners, hopefully something to maybe smile about or hang your hat on, but don't overreact. Make sure the deal cash flow is short-term. Good news is Pinnacle, PPCLOAN, Live Oak Bank, they're not going to lend money on a deal that they don't think they're going to get that money back. So they're a good safeguard, a good resource for you. Any of these lenders will, because again, not a lot of collateral in your business. So don't jump the gun, don't overreact, don't back out of a deal that, really, it might have taken a 10 or 15% hit right now in Q1, but long-term, we look at this thing in 2021, 2022, the buyers that pressed on, they were flexible, they had a reasonable seller. That's the caveat here. They'll be patting themselves on the back for staying the course, through these uncertain times. So with that, I really do appreciate Jeff, John, Dustin, all 3 of you joining us here today. Frankly, I wish we could just do these sessions live for hours. You guys have such great insights, and for all of you listening in today, a lot of great questions. There are more questions, obviously, than we could possibly get to, but I'll throw our contact information up here on the screen. If you have questions on anything related to what John had shared on the SBA programs, we'll send out some links afterwards, because there are some great resources Well, John is a great resource specifically. He's not the one you want to necessarily call. They've got good systems and processes for these things. Jeff, I think you shared a link in the chat as well on this. So we'll disseminate all of that information for you after our session here today, just so you have it. You don't have to go hunting for it. We've also got an article we'll be posting today that we'll include in that email that we send you that's got some great just educational resources and links. If you want to go a little bit deeper to get questions on some of those questions that you all had, you should be able to get that. And then we've got a lot of questions on, what to include, what to count, how to estimate what that loan would be for that payroll protection program. We've got a really great team of analysts, and our valuation team put together a model in Excel, really simple, really easy. We'll make sure that that's included, a link as well that you'll have access to. It should get you dangerously close to an answer. So we'll make sure all these resources are available to you. Stay in touch with us if you have questions. Stay in touch with your lenders. If you've got an existing relationship and you're curious on some relief or deferment, constant communication on this stuff, whether you're buying, selling, refinancing, or none of the above, just trying to stay current on this stuff. Let us know. We're all here as a resource for you. So with that, Dustin, Jeff, John, thanks so much for staying with us here today and sharing the information and insights you did. Everybody who's still on, I know we're a few minutes past to getting into the audience Q&A, but appreciate all of your time and your questions. Like I said, those we did not answer, we will make sure to get you an answer just offline. And for now, we're going to go ahead and button things up. Everyone stay safe, be well. We'll talk soon. Thanks, guys.
Thanks, David.
Thank you.
Thank you.
Signing off.